Greetings, my name is Christopher Bell. I'm a certified public accountant. In this video, we're going to calculate the present value or the current market price of a 5-year bond. That is a premium bond. Now, we'll cover bonds in more details in other videos. In this video, we're just going to calculate the present value or the market price of this bond. So in this problem, we have Bobby Corp, great name, issues bonds at a face amount of $500,000 on January 1st, 2024. The bonds have a coupon rate of 2%, pay interest semi-annually, and mature in 5 years. The market rate for bonds of similar risk and maturity is 1%. Record the journal entry for the issuance of the bonds. Now, when you get a bond problem, immediately what you should think of is, what is the present value of this bond? What is this bond worth now based on the market rate? Now, to break it up into components, we have the face amount, which is the amount that the initial investor is going to get back when the bond is matured. So, for example, if you buy a bond from Bobby Corp, and then after 5 years they pay you back, you're going to get $500,000 back. That's the face amount that you're going to get. That's the stated amount, the stated value of the bond. The bonds have a coupon rate of 2%. That means that they pay 2% of $500,000 every single year. That is the interest payment that you're going to receive. Now, the interest is paid semi-annually. That means twice a year. I actually spelled that wrong. It's paid twice a year. So you're going to get basically 1% every 6 months. The total annual coupon rate is 2%. You're going to get 1% every 6 months. That's half a year. That's half the coupon rate. And it matures in 5 years. So you're going to get that $500,000 back at the end of 5 years. The market rate, which is other bonds of similar risk and maturity, is 1%. So you can get a bond from Bobby Corp and you get 2% interest, or you can get a bond from other corporations and get 1%. Now, the big thing here is market rates, this is the market rate, this 1%, is different from the stated rate of the bond, the coupon rate, the 2%. This bond is paying higher interest than other bonds of similar risk and maturity. So the value of this bond is probably higher because you get a higher interest rate. Why would you buy, if you could pay the same price for a Bobby Corp bond as you did for another bond, why would you not buy the Bobby Corp bond if it's the same price? Because you're getting more interest. So what we do is we need to find the present value of all those future cash payments. So what we do is we calculate all the future cash flows of this bond. What are the cash flows? Every 6 months, there's an interest payment. Interest every 6 months. And then at the end of 5 years, Bobby Corp is going to pay you back $500,000. So those are the different cash flows. We have to find the present value, what those payments are worth to us today. So I made this nifty calculator, right? And we can use the present value formula, which I'll show you in a second, to calculate this. So first we put in the face amount. The face amount of the bond is $500,000, $500,000, okay? What is the coupon rate? Like I said, the coupon rate is what the bond pays every year. That's the annual interest rate. So 2% of 500,000 is what? 100,000, right? So the coupon rate is 2%. And then the years to maturity is 5 years. This bond matures or expires, it has to pay back. We have to get our $500,000 back at the end of 5 years. The number of payments, well, they pay interest semi-annually, so it's actually twice per year. So total periods, we have total of 10 periods. And that makes sense because if it's a 5-year bond and it pays twice a year, well, guess what? It's 10 total interest payment periods. And finally, we have the market rate of 1%. So the present value of this bond is $524,326. What's the journal entry? Well, before we do that, let's figure out why this is $524,326. Now, funny enough, if the market rate equaled the coupon rate, oh, look at that. The present value of the bond is equal to the face amount, but the market rate is lower. So what we do is we listed out all the payments of this bond. So every 6 months, every period, the bond is going to pay $5,000 of interest to you. So you buy this bond, they're going to pay you $5,000 of interest every 6 months. So 6 months, 5,000, 5,000, 5,000, 5,000. For 10 total periods, you're going to get $5,000. And then at the end, on the 10th period, you're going to get that $500,000 back that you lent the company. These numbers are the present value of those payments. And all I did was I took the payment and I divided it by the market rate divided by 2, because there's 2 payments per year. And then I factored in the time value of money by putting it to the period power. That sounds interesting, doesn't it? Period power. But if that doesn't make sense, we'll go into this in other detail. But basically, you're calculating the present value of every single payment. So if you go down, we can see that the actual present value of the payment is going down. Why? Because as time goes on, $1 in the future is worth less than $1 now because of opportunity cost, inflation, etc., 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 etc. But if we add up the present value of all the payments, well, lordy, it equals the present value of the bond, which is the answer to the problem. So this is a premium bond. So let's go ahead and record the journal entry. So we are getting, or Bobby Corp is getting, $524,326 in cash. Why? Because they're paying more. They're paying more interest than other bonds, so they're going to be willing to pay, people are going to be willing to give them more money. So Bobby Corp debits cash of $524,326. What do we credit? Well, first we credit bond payable. You always put the bond payable, which is the final principal payment that you're going to, or Bobby Corp's going to have to pay back at the end, at the face amount. It's always the face amount. Credit it for that. And we have a difference here. What's the difference? Well, we have a premium bond, right? The bond, we're getting more money over time than, we're getting more money up front than the face amount. The difference is going to be a credit to premium. So you just literally take the 524 minus the 500,000 and you get a credit to premium. And what we're going to do is over the next 10 periods, we're going to amortize, which we'll do in another video. We're going to amortize this premium. This premium is going to eventually go to 0. And when we pay back, or when I say we, I mean Bobby Corp. When Bobby Corp pays back that $500,000, at that point, this premium will be 0. It will be completely amortized. So that's basically how you find the present value of a bond. That's how you find the current value of a bond and record the journal entry for an initial issuance by, well, you got to put the date on there, by figuring out the present value of the future cash flows. That's how much cash you get for issuing the bond, and crediting out the bond payable at the face amount always. And then the plug is either going to be premium or discount. Hopefully that makes sense. Hopefully you learned something. We'll do more. We'll do some amortization as we go on, and I'll see you later.